Hello, this is Kyle Christian with Christian REI. Today we're going to go over real estate investing strategies. First up, buy and hold. How do you profit from buy and hold? Buy and hold investors typically try to profit off of rental income, and this is considered a passive income. Now, according to Wikipedia, passive income is income resulting from cash flow received on a regular basis, requiring minimal to no effort by the recipient to maintain it. In general, I think of this as you have cash flow coming in and you don't really have to work. And if you do, it's very little. The type of investments buy and hold investors invest in is single family homes, duplex to fourplex, and multifamily. Single family homes. What's good about them? Single family homes offer more privacy, more storage, more room for their children and pets to play. They also overall have less complaints, less turnover. Now you only have one income stream. You don't have but one unit, so you have to try and keep it rented out as much as possible and limit your time with it being vacant. Next, we also have duplex to fourplex. A duplex to fourplex is 2 to 4 units. With having multiple units, you're able to make more income. Say you're renting $400 a unit and you have 2 units, that's $800 a month. Or 4 units at $400 is $1,600 a month. So it increases your cash flow. Now the zoning is still considered residential. This qualifies you to be able to take access of the FHA loan, which is 3.5% interest. You can only take the FHA if you are going to occupy the unit, one of the units, for at least a year. While this may sound, counterintuitive a little bit, if you think about it, if you're living in one of the units of a fourplex, everyone else is paying for your mortgage, your utility bills, and you have no rent. Therefore, your baseline is extremely reduced. You're not paying as much for your cost of living. This is considered house hacking. House hacking is when you do this time and time again. You live in one unit, you allow everyone else to pay for your bills basically, and while you're doing that for a year or two or however long you want to do it, you're able to increase your savings and put that into the bank so that you can acquire another piece of property with another FHA at 3.5% and do it all over again. Insurance requirements on this is if you live in one of the units, you may be able to qualify for a single family homeowner. That way your rates don't really change a lot. If you don't occupy one of the units and you rent out all of the units to somebody else, you'll have to purchase a landlord home insurance. What to expect? You can expect that you're going to have more assets strung out among more units. Therefore, there will be increased maintenance. And you can also expect that you have more tenants, diverse culture, you may have more complaints, you may have more turnover, and these are all things that you'll figure into your budget. Next we have multifamily. Multifamily is a large scale. It's more like an apartment complex of like 20 or 30 apartments. The pros, you have more cash flow because you have more units. If you're charging $400 at 20 units, you can just see, you can imagine how much cash flow you're gaining there. Operating expenses on the other end of the spectrum. On one hand, we're going to have increased cash flow, but on the other hand, we have more moving parts. We have more units, more people. Now you have to plan for increased maintenance. You have to plan for your CapEx. Things start to need to be replaced or repaired. CapEx is more of a replacement for like HVAC, major appliances, things of that nature. Operating expenses are more of the small things of maybe needing a little bit of paint or a patch done in the carpet or something. Vacancy. You definitely want to control your vacancy rates in a multifamily because they can eat at your profits very quickly. You're going to have increased advertising costs because you're going to have more turnover. You just need to put it out there that you have units and have backup plan for if someone if someone chooses to move. Property management. This is in the event that it's too much for you to handle individually. You may not be able to do everything. You may not be a carpenter or maintenance or know much about it. Property management companies typically charge anywhere from 8 to 12% of the monthly rental value. Okay. So you need to figure up this into your budget as well. Zoning. This is considered a commercial property. Therefore, your insurance will be affected and your taxes. I recommend you get with a local CPA, qualified CPA, and consult with them. Lease with option single home. This is more of a technique. A buy and hold investor, this could be the gravy train. What this means to the renter is they accept all obligations to the property. In return, they have the option to own it in the end. For the landlord, if the renter is accepting all the obligations, the landlord don't have to do very much here, do they? They just have to sit back and watch their money coming in and focus on the next deal. How do you profit? A lease with option, you usually get $2,000 to $3,000 down before they move in. After that, they continue to pay monthly rental fees. In the event they default, they don't want to live there no more, they don't get their $2,000 to $3,000 back. You get to keep that, fix the place back up, get another tenant back in, charge another $2,000 to $3,000, and resume your place and getting your cash flow monthly streaming in. This is, like I say, this is more like the gravy train option. This is something that every landlord would love to do. The only drawback, I really don't see very many cons, but the only drawback I see is that not very many people want to put $2,000 to $3,000 down and then pay monthly as well. But it does kind of lean towards the ability to be able to obtain something tangible, not just throw away your money. So that is kind of attractive. I see that this happens more in big metropolitan areas. I don't see it so much in smaller communities, but my community is pretty small, and I know some investors that successfully do this. So best thing I can say is experiment. I advise you to just experiment, try it out. If you do it for a month and you don't get a bite, change your strategy. Do something different. Flipper. Flipper is a little bit ambiguous. A flipper can mean somebody who buys a home and puts no money into the home after he has purchased it. And this is what I generally call a flipper. And it can also mean a rehabber. A rehabber is somebody who looks to purchase a property so that they can fix it up and profit from the new value in repairing that property. Now, the actual flipper looks for highly desirable areas, places that potential homeowners and investors alike are really wanting to get into. Now, how they profit, they buy below market value. Market value may be $100,000, but they purchase it at $50,000. That's a really good deal because now you have $50,000 worth of equity that you can profit from. They sell quickly. This is because they don't want their money wrapped up inside of this deal for very long. The more you draw this out over months and months, the more expenses you incur due to lawn care, utilities, things like that. Now, the actual rehabber. The rehabber is somebody who looks to fix up the property in order to make a profit. They don't want to buy at market value either. Generally, most of the time. They need a little play, a little margin for error, because estimating repairs on a property, you're not going to get it right every time. There's going to be times when you yank up the floor and you find something hidden there you didn't know nothing about. So you need some wiggle room. How do they calculate? Well, basically what they do is they look to see what the after repair value is, the ARV. That's based on comps. Comps need to be accurate in the way that they're not very far from the house, the target house. They're within a couple of miles. 20, 30 miles is not a good comp. The comps need to be matching the age of the home. It needs to match bedrooms, bathrooms, whether it has granite countertops, architectural shingles, things like that, privacy fence, chain link fence, pool in the backyard. And you need to get as close as possible, and that provides a more accurate comp. What they'll do is they take purchase value, the market value, what they purchased it at. If they purchased it below market value, you figure that up. Like, say, if they, in the previous scenario, if they had a market value of $100,000 and they purchased it at $50,000, they immediately have $50,000 worth of equity. But if they purchased it at market value, $100,000, they have no equity in it as of right now. Now you have to think, what is the ARV? Well, let's say the ARV is $150,000. Okay, just for an example here. Now the rehabber has to look at how much is total repair cost. How much do I think this is going to cost me? Let's say it's about $30,000. Okay, well, if we purchased it at $50,000, we put in $30,000 for a repair, we're at $80,000, and the ARV is $150,000. Now, this is kind of extreme. By no means are these numbers accurate here as to what you may see in real life, but this is just for simplicity. So we're at $80,000 after total repair. Then you have another $70,000, right? You have another $70,000 to play with, to potentially profit from. Acquisition analyst or bird dog. I don't like the term bird dog. Acquisition analyst is more accurate, but we'll go with it. Criteria. An acquisition analyst needs to meet the investor's criteria. And what I mean by this is you need to ask for a shopping list, basically. Go to your investor pool and each one say, what are you looking for? And they'll tell you 1970s home on this side of town, 3-bedroom, 2-bath, central heat and air, things of that nature. You write all that down for each investor and your pool, and you put that into your filing cabinet so you can reference it later. You're going to sift through all these different deals that you find when you're driving for dollars or looking things up online, and you see potential good deals. You're going to do a rough analysis. You can't afford to do a deep dig into it on every single one. That would just waste your time. So you're weeding through. You're just trying to find the ones that look decent. And then when you do find the ones that look decent, you're going to dig down deep. And that means you're going to have to reference your county or city website, find out the tax millage rate. You're going to have to find out exactly what the utility bills are running each month. Figure out how much repairs is going to be, if there is any. Every little tidbit figure in to your analysis. Whether there's going to be a real estate agent involved, legal fees, you name it. Now you can reference that on my overview of deal analysis, where there is, I quoted a chart out of a book, and there's citations there so that you can check out that book. The other thing is merit. Your figures need to be pretty accurate. Your terminology needs to be on point, and you need to understand real estate jargon. Here's the thing. Real estate investors are pretty sharp, so they're going to use jargon, and if you say, what is that? They're going to know. This person's new. Don't ever try to be overly confident or mask the fact that you're new. Just be upfront, truthful. I wouldn't even attempt to do this until you know your mathematics. You know the abbreviations and stuff and the jargon, right? Because they're gonna throw around things like return on investment, loan to value, cash on cash, cap rate, debt coverage ratio, and you need to know those things pretty quickly and know exactly how they work. Now, it's true you can get Excel or you can get a software program that does all this stuff for you, but there's really no replacement for being able to do that on your own and know how it works, because it just makes you that much quicker in business. So it's very important to gain merit with these investors, to gain their trust, that you be accurate, truthful, and honest with them, and you figure out everything that you can into your deals so that it's more realistic. And if the numbers work out, say you overshot it a little bit. If the numbers work out anyway, it was a good deal, right? Can't go wrong with that. Okay, next we have hard money lender. A hard money lender, according to Wikipedia, is a company or individual offering a specialized type of collateral-backed loan. They tend to lend short-term capital, also called bridge loans, that provide funding or cash based on the value of the collateral. This is where the investor with enough cash basically acts as the bank. They also charge points, and you may have heard this. Points, you can pretty much replace that word with percentage. If it's 5 points, it's 5%. Don't let the jargon there confuse you. Wholesalers, they usually obtain a contract of assignment. This is a placeholder, nothing more or less. You're the middleman holding this contract between the seller and the buyer, and when the buyer goes to purchase, they have to purchase your contract. They won't know about this until closing time. Come closing time, that's when you get paid. Your investor pool. Before you get a contract of assignment, it wouldn't be a bad idea to go ahead and contact your investor pool. You can do it before, you can do it after. A lot of the real estate gurus are saying that you can hold on to this property for 30 days. I don't agree with that. I think maybe more like 5 or 6 days. If you can't close on the deal in 5 or 6 days, get a cash buyer, you don't have a strong enough investor pool. So I wouldn't even try it until I had enough investors that I could go to. What kind of profit? You can see about $5,000 to $10,000 of profit doing a wholesale. You need to understand that the seller, you need to communicate with the seller that they need to lower their price enough to where you can add your fee on top. Don't ever talk about a commission. A commission is for real estate agents and such. Your fee is a set fee. Now, some investors are pretty savvy. They're pretty intelligent, and they may find out that you've tacked on $5,000 or $10,000, and they may not be very happy. If this becomes the case, then be cordial with them and just reduce your price a little bit to play nice. How is wholesaling recognized? In my community, it's not a very popular idea. It's pretty much the black sheep technique of real estate. Now, it may be different in big metropolitan areas, but in my little community, every lawyer that I talked to said that I was trying to be a broker, and that was against the law. So I did find one actual real estate lawyer that said it was possible, and he may have to do some finagling, but it was possible. It wasn't exactly pictured in the best of light, but my advice to you is get with an attorney. Definitely get with one that is a real estate practitioner. You don't want to get with just any real estate lawyer. And if they don't know about it, explain to them. Maybe show them on a website where you've read about it or something, and explain to them the process so that they can figure out where in the law is this ability able to be done? Is it a capability or not? This concludes Part 1. Look for Part 2 at christianreillc.com or browser course material. Thank you. Don't forget to like or subscribe. Have a nice day.